Coming up on Market to Market, a genes removal could help save billions in the hog industry. Labeling fights are cooling relations between major trading partners. And one cattle buyer's quest to build genetics in herds out west. Those stories and market analysis with Mark Gold next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it. This is the Friday, December 11 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Two of the oldest companies in America want to merge. And if approved, they would become the largest seed and crop protection provider in the world. The marriage of Dow Chemical and DuPont is valued at $130 billion and came after both corporations faced pressure from activist shareholders. Dow-DuPont would become three independently trading companies focusing on agriculture, material science, and specialty products. Leading up to the merger discussion, company stock prices increased but fell after the announcement. The holiday shopping season is off to a small positive start as retail sales were up 0.2% in November. U.S. producer prices rose for the first time in 4 months at a rate of 0.3%. Crude oil spent the week below $40 per barrel, the lowest price since 2009, on high supply and weak demand. But the week started with more genetic engineering news that could be considered a breakthrough in the fight against disease in the swine industry.
The journal Nature Biotechnology Monday morning published the work of University of Missouri professors who report they have genetically modified pigs to be resistant to one of the hog industry's most troublesome diseases. Animal science professor Kevin Wells, who co-wrote the article with peer Randy Prather, said they were able to knock out a gene that responds to the porcine reproductive and respiratory syndrome, or PRRS virus. Researchers at Kansas State University conducted tests in which the genetically engineered hogs were deliberately exposed to PRRS and found the animals to be 100% resistant.
I think it's important long-term to try to develop transgenic animals or livestock that have lower impact on the environment and that are naturally resistant to more diseases.
However, because of federal regulations tied to genetic modifications, the pigs are prohibited from being sold into the food system. If the government does approve the hogs for commercial release, Wells believes the process will likely take 2 to 3 years. The recently approved genetically engineered salmon became the first modified animal to be approved as human food. The federal regulatory process required 2 decades. The Agriculture Department, which also has been working on a biotech solution to the illness, says that PRRS cost the U.S. hog industry $1 billion annually. It was first identified domestically in the 1980s as mystery swine disease. Piglets fail to gain weight after contracting PRRS, and sows can lose their litters if pregnant. Some experts remain leery of scientists moving too rapidly with genetic changes in the animal world. However, the federal government is considering changes to the regulatory system in an attempt to find a balance between new approaches to food production and inadvertently introducing problems.
As Santa begins to look over his naughty and nice list, it was hard for him to miss the negotiations keeping the government in operation. A continuing resolution pushed the deadline to next Wednesday to avoid a holiday-timed government shutdown. Several groups are trying to get a last-minute delivery of legislation as part of a larger omnibus spending bill. Food companies are working to peel off mandatory labeling for genetically modified foods. The food industry wants the labels to be voluntary. This would be similar to country of origin labeling, which too could end up on the chopping block. This week, the World Trade Organization ruled country of origin labeling established a market disadvantage for Canada and Mexico. The WTO ruling states that our neighbors to the north and south can impose retaliatory tariffs totaling just over $1 billion. Canada would be entitled to the lion's share of penalties at $780 million, with Mexico authorized for $228 million. The countries claimed that cool labeling put U.S.-raised livestock products in a better light with consumers than their non-labeled imported meats. The language of the labels is intended to inform consumers where livestock is born, raised, and slaughtered. A bill to repeal the country of origin labeling law passed the House of Representatives earlier this year, but the Senate has yet to make a move on it. 20th century filmmaker and author David Lynch once said, "My cow is not pretty, but it is pretty to me." Beauty and profit are not always tied to each other. And for one of our longtime market analysts who's built a career from the ground up, offering a hand up is all in a day's work. David Miller explains.
In the rough and tumble world of cattle production, it takes a certain type of personality to handle the monetary risks of a volatile market and the often bigger-than-life personalities who buy those animals. From ranchers in the high plains to employees beyond the packing house door, few are able to fill those boots, but Walt Hackney makes the grade. Hackney has spent countless miles on the open road over the past 6 decades, traveling from auction barn to weighing shed, buying millions of cattle from New York to California. He remains one of the few who will purchase feeders for placement, negotiate futures contracts, and sell cattle directly to packers.
I'd like to think that there are others that are as deeply interested in protecting your client base as what I am. And I believe that there are out there doing it. It helps stabilize your market.
The day Hackney graduated from Oklahoma State University, he left for Ottumwa, Iowa, and his new job as a cattle buyer with the John Morrell Company. The trunk of his car was filled with a few pots and pans, some old clothes, and a well-worn saddle.
I had visions of standing on the lower boards of a corral, looking out over a herd of finished cattle, ready for a packer to buy them. Well, it just goes to show you how wrong you can be. That first morning, I signed in at the plant, and they gave me a pair of rubber boots and a fire hose. And they said, your first job will be to go out and wash the manure out of the pens, and you keep washing them until you get ready to go home tonight.
After several months of working his way through every aspect of the production line, Hackney was put on the road buying cattle. Over the next few decades, he started a family, became a head cattle buyer for the XL Packing Company, formerly owned by meat industry giant Cargill, and in 1992, he opened Hackney Ag Associates, a full-service cattle buying and forward contracting operation. 25 years ago, while crisscrossing the country, Hackney came upon one of the most significant, single-focus projects he has ever tended, despite the fact it represents only a small sliver of his overall business. High in the Rocky Mountains, ranchers near the town of Colburn, Colorado, were having trouble making a profit on their cattle. The Colburn ranching community pushed Mike Ralston to the front of the pack to ask Hackney, who was buying cattle for National Farmer Feeders at the time, to purchase cattle from a pool of 25 producers.
Actually, I wasn't real sure when I first met him. We weren't, none of us real impressed with him, you know. You had to sort of warm up to him, and maybe he's mellowed out a little bit too, I don't know. But as a person, he's about as honest and straightforward. He gets along with everybody, which is important. What you see is what you get.
Herd size near the town of 700 varies widely from less than 10 to more than 200 head. Hackney brought his life experience to bear on the Colburn pool, and after several years of working with local producers, he has watched the ragtag collection of genetic diversity that varied from paddock to paddock become a single herd of consistent cattle.
You have to be very candid. I say now, we're going to improve on your next calf crop, and we're going to show a better set of calves than what you've delivered in here today, or you're not going to be able to continue in the group. Or you are an excellent example of what we've strived to do in your group. I want to commend you on where you're at.
The people who bought cattle from the pool began to notice the animals looked like they were coming from one rancher instead of a loosely knit group of producers. Word reached another group of cattlemen in Rangeford, Montana. They asked Hackney to take up their cause, and he agreed to lend them his advice. Both programs started attracting the interest of ranchers across cattle country in the Northwest.
I don't have enough time left, and it's too tiring and too much of a challenge to start over again with another new group. Now, if they want to come in and take a lesson off of the existing group, y'all come.
Today, cattlemen in the Colburn pool continue to feel like they're being treated fairly by the veteran buyer. David Long, a fourth-generation cattle rancher, works with his son and grandson a short distance from the weighing shed.
I just think the world of the man, the way the whole thing's set up. His crew is just like part of the family after this many years.
After 3 days of weighing and loading trucks, checks are written to pool members in Roland's living room. Thousands of dollars go back into the pockets of Colburn ranchers who are already working on the animals they'll sell next year. Longtime friend Ed Warner clears the cattle through his Albia, Iowa-based Central States Cattle Company.
We've become to know Walt as a very honorable, very honest guy, and very big-hearted, and he is fair with everybody that he deals with. If there's any mistakes or any problems, Walt's probably going to be the one to take the bump.
Farther down the buying chain are producers like Bob Frist of Hubbard, Iowa. On a foggy fall morning, he's taking delivery of 480 head of cattle from the Rangeford, Montana pool. A few years ago, Frist sought out Hackney because he wanted the best cattle available.
It don't cost you any more to feed the good ones than it does the bad ones. Ever since Walt and I have gotten together, he's always did the best he could ever do for me. Not only for the producer out there, he gets the money for the producer, but he also makes us feel like we're getting a good buy on the cattle on this end.
When the cattle are ready in the high country, Hackney will be back in the saddle putting more miles on his car. His rounds will ultimately take him to Colburn, where he can look over the pool and sign a few checks.
Our industry is one of a few that you actually grow about as much in the hard times as you do in the good times. Hard times, you're forced to really wear out a number 2 lead pencil making it work. And so the hard times and the good times thrown together, I wouldn't want to change a thing.
For Market to Market, I'm David Miller.
Okay.
Next, the Market to Market report.
Crude oil's drop is taking most commodities for a ride, and a key USDA report did little to inspire the grain markets. For the week, March wheat gained 6 cents, and the nearby corn contract fell 6 cents. A lower export trend erased last week's gain, pushing the January soybean contract 35 cents lower. January meal remains stuck in the mud, dropping $11.20 per ton. In the softs, March cotton declined $1 per hundredweight. Over in the dairy parlor, January Class 3 milk futures dropped 61 cents. Another volatile week for beef in the livestock sector as the February cattle contract lost $3, January feeders plunged $7.32, and the February lean hog contract gained $1.45. In the currency markets, the U.S. dollar index weakened, losing 0.8%. January crude hit 7-year lows, dropping $4.35 per barrel. COMEX gold shed $8.40 per ounce, and the Goldman Sachs Commodity Index lost nearly 22 points to settle at 313.95. Here now to lend us his insight on these and other trends is one of our regular market analysts, Mark Gold. Mark, welcome back.
Nice to be back, Mike.
And we are glad to have you. Producers are looking to find some sunshine amidst all of this doom and gloom. And we saw wheat as the only cash grain up this week, up 6 cents. Is that a trend starting there?
Well, we certainly hope so. The wheat market looks like it's trying to turn up a little bit from the lows that we made several weeks ago. If we can close the nearby contract over $5, that's kind of been the real resistance out here. If we can do that, maybe we can continue this rally for a while out here. There's nothing particularly friendly in terms of the fundamentals out here, but markets will tend to turn first technically, and then later the fundamentals will justify it.
We'll find the news to explain the rally. Now, we've got so far a great growing season for the winter wheat crop that's in the ground. Producers are out looking at it. No, thus far, real fear of winter kill. Temperatures are stable. For the producer watching that wheat crop, watching this moderate rally, how do you handle that?
Well, right now you can come out and buy a July put for the wheat. You can spend 30 cents and protect this downside. There's still a lot of risk in these markets. We're certainly hoping that we can see a rally. As you know, I've been friendly to these markets for the last month or two, and I believe that we can come out of these doldrums that we've been in. But the fact of the matter is, if we see big crops down in South America, if we continue to have this poor export situation here in the U.S., it's going to take something dramatic. Now, what could that be? It certainly could be, a El Nino turning into a La Nina here. We've got a long way to go on this wheat crop, and we're certainly seeing some unusual weather out here. We've got green grass here in Iowa. It was 55 degrees in Chicago. So Mother Nature is maybe tipping its hand here a little bit, so we'll see. But hopefully we can see a bounce in this wheat market that'll be sustained for a while.
Okay, and is this a price level you're excited about spending that money on these puts, or do you let it run a little bit and see if you can get some more value?
No, I think you've got to manage the risk here now. Okay. Am I excited about buying a $5 wheat put? No, but knowing that the risk is still $1.50 or $2 in this market is something that you've got to be prepared for. You spend the 30 cents and hope that we can get a $1 or $2 rally down the road.
All right, and sell the physical for a little more.
Yes, absolutely.
Than what we got today. Now, we did see a 6-cent decline in this corn market. Are we watching spread trade? Was that driving wheat today? Is selling corn, buying wheat, or is that much of a player today?
Well, it hasn't been. They've been kind of going neck and neck for the most part. Okay. The beans have been kind of the leader or the dog. The wheat is taking its role in here, but the corn just stays in this range of $3.60 to $4. If we can close the nearby over $4, that'll be helpful. The charts are starting to look just a little bit better in here, but the biggest problem I see with these grain markets, both corn and beans, is the American farmer is holding on to so much grain from the 15 crop yet. They haven't priced anything in 16, and that tells me that's a Damocles sword still hanging over the head of this market. Now, that doesn't mean that we can't rally, because I still believe we haven't any clue really what the Brazilian crop's going to be in soybeans. We see demand maybe picking up a little bit at these levels. So again, I'm still hopeful that we can turn a corner in this corn and bean and wheat market and see some higher prices out here.
That being said, for the producer who at harvest locked it up in commercial storage till January 1 or right. Figure end of December, right. What's your advice to that producer when his corn is free? Or if he's got free corn, unpriced corn on the farm right now, how do you handle it?
Well, a lot of guys are going to want to wait till after the first of the year for obvious tax reasons. But the basis right now in a lot of areas, because the farmers aren't letting go of this grain, has been pretty strong. There's nothing wrong with locking in some of that basis now and then maybe selling it after the first of the year. My best advice is to make some sales at these levels, but immediately re-own it with call options, because I believe that between now and September, we're going to have at least one great rally in these markets. I don't want farmers to be selling 370 or 380 corn out here and not have any upside open. But there's still a lot of risk out there, so we want to get the grain out of the farmer hands, buy the call option, and let's look for the upside in this market.
All right, now 32 cents down in the soybean, or 35 cents down in the soybean market this week. Whew, for that producer out there, this was a tough week to stomach. Are we going to go back and retest those highs we hit last Friday?
Well, it's going to be a matter of, I think, Brazilian weather. It looks like their weather is going to turn a little bit better, particularly in the center part of the country there. But the northern part of Brazil, from all the reports I'm seeing, still incredibly dry, a lot of problems there, and I don't know that we've discounted that. In fact, the latest reports have another 1 million or 2 million metric tons of production coming out, up to 102 million metric tons out here. So I don't think they've really gotten a whiff of maybe how bad it is up in the north. So there are a lot of things that can turn this market around. The Chinese, I still believe, are going to be solid buyers, particularly on these breaks out here.
Sure.
So again, I don't want to be bearish down here. I want, if we are selling any soybeans, I'd certainly be re-owning with call options.
All right. And now I just want to touch on, as we talk about the producer side, we're seeing down prices for the end user. Bean meal down $11, $2.73. Are you a believer in locking it in at these prices?
I don't know that I'd lock it in, but I'd certainly be buying call options to protect it. So you can go out and buy it, lock it in, do some advanced purchases out there. But if for whatever reason we are going to see a big Brazilian crop, those meal prices still have a lot of risk in them. So we want to buy the call option. We know we can define the risk, $5, $6 a ton out there, have something in our pocket in case we go higher, because these historically are pretty good levels to be owning something.
Okay. All right, well, now let's jump into the livestock markets. We saw $3 down in the live cattle market. Are we close to finding a bottom, do you think?
Well, it looked like on Thursday we had a pretty good reversal day on Thursday on both the fats and the feeders. We didn't have quite a key reversal, which I think guys would have felt a little bit more comfortable about, but it was an outside day. We closed higher, made a new contract low. We followed it up with mixed prices on Friday, a little bit lower in the fats. The feeders were, the feeders were a little bit lower. The fats were a little bit mixed. So nothing definitive there. Is the worst over in this market? I think it's probably the wrong time, maybe after the first of the year. We can see maybe one more shot at the lows. And then, you know, this has been an awful hard break. Can we see a rally? I still believe we can see a $10 to $15 rally in the feeders at least, and a $7, $8, $9 rally in the fats out here. So, you know, I'm hoping that we've seen the worst of it. I think we've put in a lot of bearish news into this cattle market. But again, we have to watch the stock market. We've sold off hard in the stock market, and I've always said, keep an eye on that stock market to watch the cattle prices.
You bet. Now, you touched on this first question. We've got a question from one of our followers on Twitter. This is Chris in Minnesota, and he's asking, when does the absolute beating in the cattle market stop? Hopefully, we're getting close to the bottom. But his follow-up question is, would you say this prematurely halted the nation's herd expansion? This massive break in feeder cattle, has this scared a lot of those heifers back into the feed yards?
Well, I think it's a great question. We generally see when the cattle cycle starts to switch that it kind of goes in that trend, and it's kind of hard to put the brakes on it. Will guys take a look at this, and will some of the bankers take a look at this and say, well, maybe we need to back off of this a little bit? I think that's possible. I don't know that in the long run we're really going to put the brakes on it. I think the bigger problem right now is we're feeding onto ourselves with these heavier weights. And, you know, guys keep on holding them back, getting more and more tonnage coming into these markets. I don't know that the numbers themselves are so bearish, but the tonnage is bearish.
Right.
So that's been a big problem in this market. The first of the year tends to be a good pivot area. So maybe we make some lows in the first week in January, and then maybe we can head higher.
Okay, maybe get some opportunity for some risk management in place once we cross that first of the year.
Absolutely.
Okay. Well, now we've got one other bright spot in the markets this week. We had wheat, and then on the meat side, we've got lean hogs. Tough to call $60 pricing a bright spot, but it was up $1.45 on the week, Mark.
Yeah.
More room to the upside here in these lean hog markets.
Yeah, if you look at the chart on the hogs, it actually looks pretty good. And I've been saying for quite some time, I thought the hogs would hold up pretty well relative to the cattle in here, and that's what we've seen. Even on the hard breaks in the hogs made, you know, $2 or $3 lows in here, but they've come right back. I thought Friday's close was pretty strong, and the charts look good, so I continue to believe that we can see some upward indicators in the hogs, and I continue to believe the hogs will outperform the cattle in here. Now, if we do get the bounce after the first of the year, can cattle take a leadership role for a while? Sure they can. But I kind of like the hog market here, and I think there's more upside potential, maybe 68 cents, somewhere in that range in the nearby. So
So here at this level, are you putting any risk management in place for producers, or are you waiting to see if this thing continues a little bit?
No, we've had a decent bounce in here, and you can buy the puts a little bit cheaper. So even though I'm friendly to the hog market, it doesn't mean I'm right. And as a risk manager, we want to protect the downside because there's an awful lot of risk out here. If we were to take out these monthly lows that we made this month, then we're looking at perhaps a steep drop in this hog market.
Still.
So as a risk manager, we're going to spend about $2.50 a hundred to protect these prices, and let's hope that we can see $70, $75 hogs out there.
All right. Now, we've talked a lot about the headwinds facing the commodity world, the dollar being one. We saw a big sell-off last week when Janet Yellen seemed to confirm raising rates. Next week they'll meet. Is the dollar going to climb after the Fed report, or do you think we'll have another sell-off?
Well, that's probably the question of the ages. You look at the chart, and it looks pretty toppy to me in here. We've pumped a lot of good news into this market. Is Yellen going to raise the rates on Wednesday? I think it's better than a 50-50 chance, but the bond market isn't telling that. The bond market on Friday was up 2 basis points. It seems to be the opposite of crude. As the crude keeps getting lower, the bonds keep rallying. Now, if we raise interest rates, are the bond prices going to collapse? I wouldn't be surprised. But the fact of the matter is, I think the dollar's overbought in here, and it's got some room on the downside.
Perfect. We'll explore this a little bit more in the Market Plus segment, which you can find on our website. Mark, thank you so much.
Thanks, Mike.
That wraps up this edition of Market to Market, but we will continue our discussion, as I mentioned, in the Market Plus segment available on our website. We also encourage teachers, students, and anyone else who wants to learn more about the business and science of agriculture to visit the Market to Market classroom on that website. And join us again next time when we'll examine a dairy state's diversification to hedge against market volatility. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it.